For the first time this year, the Greek crisis slipped out of the headlines during July, but not before the Syriza government quite astonishingly caved into the demands of its EU and IMF creditors and accepted extremely tough terms to enable third bailout negotiations to begin. Regrettably for the long-suffering Greeks, the terms are much worse than those that could have been negotiated at the beginning of the year, and actually materially worse even than those on the table before the referendum was called in early July. But Prime Minister Tsipras ultimately accepted reality, and he went for the least bad short-term option by staying in the euro, accepting those very tough conditions to enable an extension of credit and avoiding an immediate default. The outcome, a classic sort of EU last-minute deal, effectively kicking the can down the road yet again, removed an immediate risk of the euro project going into reverse and provided a fillip to European equity and bond markets. But with Greece sidelined to a minor issue, at least for now, investors focused on events in China, where all the evidence points to an economy that's slowing more rapidly than the authorities would like. Although the official GDP numbers show growth at the targeted 7% in Q2, few believe the veracity of the figures, with most indicators pointing to much slower growth, perhaps in the order of 4 or 5%. What is beyond dispute, though, is that in the face of overcapacity and overinvestment, capital spending, for so long the great driver of the Chinese economic powerhouse, is waning, and growth is being taken up by the consumer and service sectors. In turn, the economy is becoming less commodity intensive, and the effect of this was abundantly clear in July as virtually all commodity markets suffered another sharp leg down in their bear market. Exacerbating the situation has been the boom then bust in the Chinese stock market. Having doubled in 12 months, the market plunged in June after a brief rally triggered by extraordinary intervention by the authorities to try to arrest the decline. Market forces took over again in July. Despite increasingly aggressive efforts by the authorities, including suspending some 1,600 stocks, close to 50% of the market cap, from trading, substantial liquidity injections, a ban on major shareholders from selling shares, market forces, fear and deleveraging ultimately drove prices lower, with the market collapsing by 8.5% in a single day, down 14% in the month. While few foreign investors have direct exposure to Chinese domestic stock market, there have been knock-on effects in Hong Kong and in Chinese stocks listed in New York and elsewhere. Perhaps more importantly, investors have seen the weakness as a further sign of troubles building in China and a reflection of an economy going through a serious adjustment to its growth dynamics. The importance of China to the global economy is on a totally different scale to Greece. The parlous state of the Chinese economy has far-reaching global consequences, and the deeply worrying and I think ultimately damaging state intervention into the stock market undermines the widely held perception that the authorities had control over most, if not all, aspects of the economy and financial system, and it casts doubt over the program of liberal reforms that are planned. These factors explain much of the collapse in commodity prices, especially industrial metals over the past year, and the further sharp falls in recent weeks. It's no coincidence that the latest falls in commodity prices started in mid-June, precisely the date that the bubble in the Chinese stock market burst. Broadly based commodity indices were down by 11 or 12% in July, led by oil down 18%, copper down 10%, other metals following a similar pattern. Even precious metals were not immune, with gold reaching new lows for this bear market, down by 6.5% and breaching the $1,100 per ounce level. Fund managers with significant exposure to these areas have suffered pretty badly in recent weeks. Events in China are also hitting those companies in developed markets with significant exposure to the Chinese market. There have been a series of warnings from car producers, suppliers of capital goods, luxury goods and other consumer products that the Chinese boom has gone into reverse, with damaging consequences for revenues and profits. I think this is unlikely to turn anytime soon. Perhaps the most notable and important move in resource markets was the renewed decline in the oil price. After a period of recovery and stability following the collapse from $115 last year, the oil price entered a renewed sell-off, Brent crude falling below $50 a barrel, a level first reached 10 years ago. With the global economy sluggish, China slowing rapidly, US shale production remaining at high levels and Saudi Arabia pumping at well over 10 million barrels a day, the market remains in oversupply to the tune of close to 2 million barrels per day. On top of this is now the prospect of Iran rapidly increasing production as soon as sanctions end, expected by late November, following the signing of the nuclear deal between Iran and Western powers. There are indications that Iran will actually have no difficulty increasing production rapidly and will be able to ramp it up by 1 million barrels a day within 1 month of the ending of sanctions. Little wonder then that the major oil companies around the world are now planning for a long period of low oil prices and have slashed capital spending by a staggering $200 billion in recent months and are cutting large numbers of jobs. These cuts will ultimately curtail production and global growth will eventually absorb the excess supply, but the cycle has some way yet to run. In the meantime, the further drop in the oil price is unambiguously good news for consumers and will help to support growth in the year ahead. The initial impact of events in China and commodity markets has been particularly damaging to commodity producers globally and to emerging markets, which fell 7% in the month, extending their long period of underperformance versus developed markets now into its 5th year. Natural resource shares are down by around 10% over the month and 20% over 3 months, with some signs of capitulation selling in recent weeks, especially in precious metals producers. However, outside these areas, investors were encouraged by the turn of events in Greece, the increasing likelihood that the strengthening headwinds to global growth, compounded by the problems in China, would delay the Fed's first interest rate rise and keep rates lower for longer. Developed equity markets rose by 1.8% in the month, with Europe leading the way, while in fixed income markets, government bonds returned around 1 to 2% in local currency terms. In fact, only high-yield bonds in the US and convertible bonds produced negative returns, weighed down by exposure to China and to oil producers. The other big issue for investors is the timing of the Fed's first increase in interest rates in this cycle, with GDP growth for Q2 coming in at around 2.3%, wage inflation remaining at 2%. There are no immediate pressures. And the turn of events in the global economy, with growth evidently slowing, will give the Fed a further reason for caution. Market expectations are still for a first rate rise, most likely in December, with September still possible. But the key issue in our view is not the timing of the first rate rise, but the extent to which the Fed ultimately tightens policy in this cycle. And in this respect, we see the evolution of the global economy in recent months as more conducive to the dovish approach. So lower for longer remains the mantra. We continue to believe that interest rates in the US will remain well below previous cyclical peaks for many years ahead. With the exception of emerging markets, most equity and bond markets have been trading sideways since the end of February. Supported by continuing low interest rates across the developed world and huge asset purchases by the ECB and the Bank of Japan, together with signs of modest but improving growth in the US, Europe and Japan, prospects remain favourable for all risk assets and especially equities. There are, however, some specific headwinds which have become more prominent in recent weeks, notably the slowdown in China and its impact on commodity markets and other emerging economies. Although the Greek crisis has eased, at least for now, the evolution of events in China will continue to reverberate globally. Ultimately, expectations and price levels will adjust to this new reality, but the process of adjustment is painful in some sectors and countries, and this is likely to keep a lid on markets in coming weeks, a time when the Fed's first rise in rates will be in sight. So we expect this current lull and period of consolidation in markets to continue in the short term, but we remain firmly of the view that the upward cycle in markets has considerably further to run. So we'll be looking for opportunities to add to risk in our portfolios during this risk-off period.